The silent ticking of the economic clock is getting louder, and the Federal Reserve is caught in the middle. The Federal Reserve is currently in one of the most dangerous policy positions it can be in: prolonged indecision. Interest rates remain high, but the Fed has avoided giving clear guidance on future cuts, leaving markets in a state of crippling uncertainty. While inflation has cooled significantly from its post-pandemic peak, it remains stubbornly sticky in essential areas like housing, insurance, and the services sector. Meanwhile, the momentum of U.S. economic growth is visibly fading. Job openings are steadily declining, small businesses are struggling under the weight of high borrowing costs, and banks across the country are aggressively tightening their lending standards. This has created what economists call a policy trap. The Fed knows that cutting rates too early could reignite the inflation fire, but keeping rates elevated for too long risks pushing the entire economy into a structural slowdown. Because of this silence, markets are being forced to speculate rather than respond to a clear strategic direction. Historically, these periods of Fed uncertainty are the calm before the storm, often producing sharp and violent market moves. As indecision continues, financial liquidity begins to tighten, risk appetite fades, and systemic stress starts building beneath the surface of the banking system. The real danger here isn't a slow, controlled decline. It's a sudden, chaotic repricing of assets the moment investor confidence finally breaks. Data from major institutions like J.P. Morgan already suggests a 35% chance of an economic collapse in 2026 if this policy paralysis continues. The Federal Reserve's wait-and-see approach is no longer viewed as cautious. It's now being seen as a gamble with the nation's financial stability. The longer Jerome Powell and the Fed stay silent, the greater the risk of an abrupt, uncoordinated market reaction that could trigger the very recession they are trying to